Welcome to the State of the Markets podcast. I'm Paul Rodriguez of thinktrading.com.
I'm Tim Price of pricevaluepartners.com.
And our very special guest is Ben Ashby.
Ben Ashby, welcome to the show.
Thank you very much for having me, guys. As Australia, as a long-term listener, I'm very honoured and privileged to come on the show.
Well, you may feel different after the next hour, but anyway, let's see how we go. So for those people who may not know you, would you care to make a brief introduction yourself and your firm?
Yeah, no problems. I'm the Chief Investment Officer for a subsidiary of a much larger US fund manager. So the UK subsidiary is called Henderson Rowe. We largely deal with ultra-high net worth individuals. The parent company is known as Radiant Global Advisors. We are pioneers of whatever we would now call AI-based investing. We would probably describe it closer to applied data science, but that obviously still means that humans are involved in some level and some kind of human decision making's in there. So that's what we do. So we basically apply advanced data science methods to financial markets to construct portfolios.
But you've also been in the city for some time in terms of various sort of, let's say, more established traditional banks as well, haven't you?
Yes. So where do we start? If we start at the very beginning, I started working for the government. I'm
afraid we're going to have to terminate this interview now. Great having you on, Ben. But
well, having seen the government from the inside, that was a very good early indicator about collective incompetence.
Having said that, which government are we talking about?
Oh, well, I was a civil servant. So I basically, I did debt restructuring and debt recovery for a part of the Inland Revenue. So companies go into difficulty, things like that. Because the government's always a big debtor.
So you've seen the blob from the inside?
I have seen the blob from the inside, yes. And there's a couple of colleagues of mine that I've known over the last 30, nearly 40 years who also decided relatively early on they could see the decline. But yeah, the government always tends to end up being a big creditor at the end, whether it's outstanding corporation tax or whatever. So it's always involved in a corporate restructuring. So that's where I started. From there, I kind of went into emerging markets. Via initially Credit Suisse First Boston, which obviously morphed into Credit Suisse, another firm that didn't hugely surprise me when it got into deep difficulty because it looked like a madhouse when I was there, and it seemed to deteriorate further from there. And then I moved on to JP Morgan in two very long stretches. And in between there, I was at HSBC before moving on to Radiant Henderson Rowe.
How did Henderson Rowe come about then? How did your paths cross?
It was kind of fortuitous because Morgan towards the end, the part of JP Morgan I work for is possibly one of the more secretive parts. It's called the Chief Investment Office. So it actually manages JP Morgan's own money. And some of that is long-term investment and some of that is just the managing of reserves, liquidity positions and various other things. And simply the portfolios were enormous. When I left, they were around about $500 billion. And that excludes all the various other sort of pots of cash that you had to manage. But that would be your kind of core investment portfolio. And they were early adopters of what they would have called big data at the time. So I got involved with some of those big data type projects. So some of the big brains in New York who have since moved on, but they could see where the wind was blowing. And it was a real eye-opener for me in terms of just how much more processing power had moved on. And obviously, everybody's very familiar with it now because you've obviously had OpenAI and various other sort of imitators. So I had some connections with parts of the Radiant business. They themselves sold their previous incarnation. If you have a look at our senior management, which I think theoretically I'm part of, but I'm the thickie because all the rest of them are pretty much all PhDs from places like UCLA, Caltech, Cambridge. And effectively, this is their new venture. So we were set up about 4 or 5 years ago. And we bought Henderson Rowe because we saw a really big opportunity in private wealth management in Europe generally, but also in the UK, just simply by introducing actually, very innovative, very new type products.
Or just perhaps basic intelligence.
Since I have to deal with these people, and as I know you do as well on a regular basis, I might phrase it differently, but let's just say they would have struggled to get jobs at some of my former employers in any capacity. So, but it is what it is. But I think it's an industry that's due for a shake-up one way or the other, whether it's through advice or whether it's through products. And that was my colleague's view. And so far, it's been very successful.
Here, AI and big data, and I can hear Paul salivating on the other end of the line. So I think we should let Paul in now.
They do the big data and you have the practical experience. Would that be fair? Is that what you're saying?
There is an overlap there, yeah. I've got some, in fairness, so I've worked with a vast amount of former academics and former PhDs. And the thing I'd say about my current colleagues is they're very commercial. They are very entrepreneurial, which is, for people that have usually dealt with, say, PhDs in physics, it is a bit of a struggle. About getting them to say, look, there's more than outside the model. So I'd say there's an element of my practical experience to theirs, but that would very much be underselling some of them. Some of them have got, long portfolio management experience themselves, but they would be probably more biased towards the research side of things.
So how do you position yourself in terms of performance? What do you invest in, and what do you measure yourself against?
One of the core strategies we've got, which, I'm happy to discuss where the weaknesses might be, but instead of trying to be all things to all people, we just decided to focus on 2 or 3 things and doing them really well. And so we kind of focus on a sort of global equities portfolio, which would be normally biased towards growth. But again, because it's actively managed, we obviously will pivot it into sort of more value type strategies at periods of time. And we've focused on what I would call more of an income-based strategy, which is kind of a hybrid sort of bond, bit of equity type strategy. And that's literally where we've concentrated ourselves.
Is that direct equity or funds or ETFs?
Direct equities.
Yeah.
So again, one of the advantages we have as well, without going through sort of like the theory, but it's just building portfolios through smaller stocks. So the overall portfolio behaves in a fashion that you want it to, because you've kind of decomposed the portfolio down to various parts. So our CEO and founder, Jason Su, you might not have heard of, but his former business partner was at Research Affiliates, and that was his previous firm. He's the co-founder. So for anybody that's kind of been into factor-based investing, Jason is the inventor of factor-based investing. So again, digitizing that, pulling out those factors and then finding those similar quantities and using applied data science type models to find those kind of portfolios and portfolio constructions is where a lot of this has come from.
Okay, I'm not sure I quite understand that. It sounds like tokenization, or am I on the wrong track?
Wrong track.
Okay.
Sort of, happy to talk about tokenization.
Restrain your crypto enthusiasm, Paul, please. You guys get a room.
Factorization of stock investing.
Yeah, if you break down stocks to certain qualities.
Trump coin.
Yeah, that's right.
So I do an occasional podcast. It's a very technical one. I do it for my professional body, and it's called Future Proofing Finance. And we've just it only comes out every couple of months, and it's very much focused on industry-based kind of way of looking at things. So I don't recommend it, and it's certainly no competitor to you guys.
So you do a podcast, you don't recommend it, right? That's
no, not to your.
That's the first time I've heard that.
We like the cut of your jib, Ben.
Honesty in advertising.
Yeah, brilliant.
It's aimed at a very technical practitioner type audience, and we've got one coming out next week, and it is an expert in tokenization and factorization, and he makes some comments on Trump coin and Melania coin, most of which we had to edit out, but I think you get the general gist of his view and the infrastructure behind it and what was going on from listening to him. So it's just as an aside.
Okay.
So factors, you just break stocks down to certain qualities. So the most common one would be things like growth or value. Is that what's driving the market, or is it momentum, which is the other one that's very well known? So you sort of extract the various qualities of a stock, and then you kind of construct a portfolio that might have a certain composition of growth, a certain composition of cash generation, and a certain composition of momentum. So that's how we'd do it. We'd use broadly 3 types of models to do that. The one that most people have heard of would be a neural network. The other one that we tend to use is K clustering, which people are sort of familiar with, because it's often how Netflix makes some of those strange film recommendations to you. So that's effectively where some of the maths comes from, and that's what we kind of do. So rather than going in meeting management teams and going through it and wearing out lots of shoe leather, we basically bung it into a huge model, take the data and build probability weighted portfolios.
Which sounds fine in principle, but then when you come across, no names, but I think it's MSCI, MSCI Value, MSCI Growth, then you find out that Microsoft's in both of them, and you think this is absurd.
I completely agree with you. So Microsoft has rarely ever involved itself in our portfolios. So, I mean, look, other things you can sort of arbitrage over time is things like small cap, which I know hasn't particularly worked out over the last 10 years for most people. But
everything's been NASDAQ growth. I mean, as long as you're in NASDAQ growth, you were laughing for the last 10 years.
Yeah, but it's not to say that there aren't opportunities outside of that. It's just they're not open to very large fund managers because obviously they can't get the liquidity. So there's an arbitrage in of that. Another thing, why are they particularly interested in high net worth individuals, or we, since I'm part of the company? Because the money tends to be more sticky. So therefore, because it's more sticky, you get longer time frames, and therefore factors such as probability starts to weigh more. So you don't have to worry about monthly or quarterly returns to the same basis. You can kind of push things out on a further time frame. And once the portfolio starts running, you can start laying down investments today that you expect to perhaps pay off on a 9-month, 18-month time frame.
So when I was asking about benchmark, I think that's why this becomes an interesting question, because as Tim's saying, if you invested in the NASDAQ stocks, obviously you're going to have done very well, but that might not necessarily be what you're benchmarking yourself to, and it might not be what your clients want anyway. They might not want the risk. They obviously would want the upside, but a lot of the time, high net worth individuals just want you to make a good return, but not an outsized return that also risks them losing a lot of money.
Yeah, exactly. So look, generally what we use, because you've always got to have some kind of benchmark in there just to explain, this is what you could have won. So we use ARC, which seems to be industry standard. So I'm from an institutional background, but ARC seems to be the standard in our world. They were bought last week by the S&P Dow Jones indices, so they're clearly going to get rebranded. We crudely would probably just use MSCI World equities for that.
Right.
And we specifically pitch ourselves as more of a niche provider. It's lovely that you might want to give us all your money, but the reality is a lot of ultra high net worth individuals like to have big brand names on there. They tend to view asset managers, as quasi banks, and therefore having a sort of bank type name on there, regardless of what performance or what they're selling you, factors quite highly for them. And so we kind of say, look, we are a genuine diversifier. This is what we do. This is how we do it. Here's a benchmark you can look at, but we're not managing it to it because, look, this is what's in the benchmark and this is what we've got. There's not a lot of, if any, overlap between the two. But that's kind of how we pitch the business. And actually that's worked so far because the performance has been very good. And again, people are more inclined to kind of give you cash. So rather than going out and being your classic without naming any names, but we do all things to all people, and most of it you can actually get through an ETF and pay a fraction of the cost. There didn't seem to be much value in that for us as a business. So, like I say, we've aimed to try and be very good at what we do in those niche areas, and focusing on maybe being number 3, number 4 on some very wealthy, well-known individuals' lists, if that makes sense. And if the performance grows, they get more comfortable. Their AUM grows anyway, and they're more inclined to give you additional money.
To that point, do you foresee some kind of a shakeout in the asset management industry or wealth management industry, whereby those players that are frankly not really delivering anything of value ultimately get weeded out, and the money flows to those people who are actually generating alpha?
You'd like to think that, Tim, but as we'll probably get on to the conversation elsewise, I mean, we do code up quite a lot of human behavior that would suggest a quite marked change in human behavior. Do I think there's a bit of a shakeout coming in the private wealth management industry? Yeah, absolutely. Because, I mean, in many of these cases, they're massively overcharging for stuff you can buy off the shelf. So what you're effectively paying for is somebody to do that for you, because some of these clients, I don't know, sophistication, but lack the confidence to want to do that for themselves.
Or time, possibly. Time for it.
Yeah, or time. But there's two, and I don't know how we rephrase it. I'd like you to edit it out, but I mean, just picking two examples. But I mean, you can pick up their core portfolio for a fraction of the cost. I think they call it, and they're on Fidelity. And you think, well, wait a minute, why am I going through the door and paying literally 3 times the cost when I can kind of pick up these funds, with your model portfolio construction of Fidelity at 25 basis points? That doesn't make any sense to me, and I don't think that's long-term sustainable. And the other one would be just somebody along the lines of that they bought 3.5 trillion. You are the market. How are you going to outperform? So you're 3.5 trillion with a massively inflated kind of cost to clients. So what are you going to do? Well, you're going to stuff them into a load of structured products and hard to get into hedge funds with questionable performance and charge them for it. But ultimately, the problem you have with a lot of this is you're offering what is a tailored service to people, but you can't make those maths work. So you're repackaging a mass market product. So I don't know how you'd want to rephrase that, because clearly I'd like to avoid putting the names, but yeah, I think a shakeout's coming. Look, it's between you and I think the reason why they did was because they wanted to gross up AUM before they sold themselves. At some point, I think the penny drops, and I think again, once we get a change in liquidity environment, that people are going to find being in MSCI growth isn't necessarily the win-win that everybody thought it was, and you're going to end up with market forces, beginning to reassert themselves, and suddenly everybody realizes these industries are very, very hard to scale. And that would be the issue we'd have at some point. Once our funds get beyond a certain size, there is a reasonable probability we start to suffer from diseconomies of scale. And then it ends up becoming a business decision about what we want to do. Given we're all personal investors, at the moment, we're very much aligned with performance. But that might be a question over time about where we wanted to pivot things. But let's just view it as a high quality problem once it turns up.
One of the reasons I was keen to sort of extend the invitation to the pod was, I think it'd be fair to say you're fairly outspoken on both the presentations you've made and also the commentaries you've put out. Would you agree with that? Would you concede that point relative to the industry?
Yeah, I'd agree with it. I think, are you saying, am I too gobby for my own good?
Well, could you give us an example of what that actually is? Because obviously there'll be people who, and I think what Tim's alluding to is your Substack, which I haven't actually got around to seeing, but maybe the people who haven't got around to it wouldn't mind knowing a bit about what's on there.
Yeah, so over the years, I get asked a lot for my opinion, sometimes by journalists, and occasionally I've written articles. And so the Substack kind of came around for two things. One was there's a stack of articles that never got published that I was asked to write, and then they didn't like what was in there for various reasons. So the first one that's come out, the first one that I kind of come out, if you have a look at the very first thing I put on my Substack, was an article just pointing out as a former employee of JP Morgan, and JP Morgan trained, that everything that Citigroup's doing at the moment is pretty much a how to not restructure a bank. So we will see what happens. But oddly enough, the financial press, despite asking me for that article, didn't want to publish it. So it's almost as if it's a big advertiser.
What that reminds me of is you'll know the name Russell Napier, I'm sure.
Yeah, I know Russell quite well.
Who's one of our favourite strategists, and one of the reasons I think we particularly like him is because he's also a financial market historian, which sets him apart from a lot of the rest of the business. And I remember him saying it's not a proper recession until Citigroup's gone bankrupt. So I think Citigroup's gone bankrupt at least 4 or possibly 5 times over the years. But you know it's a real recession when they have to sort of file for Chapter 11. They get bailed out.
Let's put it like this: since I'm now trying to be more diplomatic, since
we can beep out. This would be quite funny to have. This could be our first beeped out, heavily redacted podcast.
Yeah, look, Citigroup is just an inherently unstable bank, and the problem that you get with organisations is once they turn, shall we say, subpar or
subprime.
Yeah, it's very hard to change that culture, and it's very hard to turn those companies around. And look, all companies atrophy over time. So if you're looking for my core skill, is I'm a credit investor. So again, you kind of take a longer term view of things. You've kind of sit in that intersection between equities and fixed income and rates, obviously. But yeah, so the Substack was basically those articles, and it was a few other pieces which don't really sit in client notes. I do a fair bit of LinkedIn, and that's all done for sort of what they call social proofing, a bit of advertising. Amazingly, we do get walk-ins, obviously with fellow professionals, because you probably know this, Tim, as well, as an investor in your fund myself.
Oh, thank you very much. Checks in the post.
But the thing is, you're aware of what is good and you're aware of what is not good. And the problem that you have is a lot of the provision, unless you want to do it for yourself, and again, you're already time strapped. And if you weren't time strapped already, the moment you work inside a large financial institution, it's very difficult to do your own finances because of so many regulatory checks and balances.
Well, this is the thing that even if you wanted to, then as you said, the compliance function. So we have a few clients, or we've had clients over the years that have been, say, involved in maybe legal or accounting, and they have to get pre-approval for everything that takes maybe days, and the whole thing's just unworkable.
Yeah, I'm totally with that. So you're always looking for something like, look, do I trust you with your money? And I don't really care too much if you underperform the market for a period of time. What I don't want is I'm going to wake up one morning
and find there's nothing left. It's gone.
Exactly.
And it's gone.
And it's gone. And it's that kind of composition. So I do that, and Substack was just an extension of that, and for various other sort of rants and pieces and follow-up bits.
Do you find Substack useful for getting in third-party research that you might otherwise maybe not get for free?
Yeah. Yes, I do. And I also find that with the general collapse of the quality on the sell side, I find that there's a lot more quality writers now on Substack, and they're much more candid. So one of the problems that you've had is obviously, I think the term in the city is de-junification or junification. So effectively, you've brought in a bunch of juniors who, with like 5 years experience, are meant to tell you what you're expecting next and how to analyze companies. And the other problem you had was the massive outsource of jobs to India. And of course, that sort of destroyed the pipeline of young sort of North American and European analysts. So they brought people in from effectively that were Indian support analysts, which you might not have necessarily hired in the first place. And now you're in the position of being asked to pay a lot of money for this stuff. And you think, well, wait a minute, why don't I just go to another Indian outsourcing company and get it direct for a fraction of the cost? So they've never really managed to work out how to make that research business pay. MiFID II, which has further complicated things. And, if that wasn't bad enough, they decided to seriously de-skill it. So I certainly find there's better quality writers on there, and some of them got skin in the game.
I mean, my recollection of how this works, and I've worked for one or two sort of, what do you call them, full service houses in the past, bulge bracket firms, is that it used to be the case that it was actually quite expensive and quite difficult to get execution on the stock market. We're going back, say, to the 80s now. And then it became basically free with the likes of Charles Schwab and E-Trade. And then firms ended up bundling research into the execution because to sort of do a sort of smoke and mirrors, shell game trick. Well, because the execution is now free, you get bundled research as part of the deal. But actually the research is no good because, as you would expect, if you're lumping in research from a firm that wants you to buy stuff anyway, why expect it? It's like, Buffett talking about nobody ever goes to the barber and asks if they need a haircut. So people naturally expect the research to be garbage, which by and large is.
Yeah, I wouldn't disagree with it. I still think there's some notable people out there at big firms who write useful research, but I think
they are the exception rather than the rule.
Yeah, they are now. And it's annoying because as a small fund manager, you would like to have quality research from time to time, just as a secondary opinion and things like that. But that's not really what you see anymore. To be honest, I mean, look, they've got a bigger issue anyway. I think, would you even bother investing in it now? I mean, a lot of this is going to go down the AI route. I mean, look at the rating agencies, particularly one of them that tends to be more model-based. I think it's very likely over the next 5, 6, 7 years that more and more of that's just going to be done by AI.
Talking of which, what does AI give you that you couldn't actually do yourself with people with your own research? What sort of things will it throw up that you have gone, right, I couldn't have found that myself, it's found it, or whatever it might be?
I would say pictures of pneumatic AI chicks, but that's just me.
If I've never checked its browsing history, so now I'm now concerned about what it might be looking at. It would be the ability to just analyze millions of data points and bringing those millions of data points back into a view and then just bolt it into a probabilistic weighted view of the world. So
no, yeah, I get that, but that's what it's doing. But how do you measure that? Like, how do you know that you say if you'd spent a week doing your own analysis and looking at various companies, that you didn't maybe necessarily need to look at all those data points? You might have just decided that, say, you wanted to buy Nvidia because you could see it was a good momentum stock. What is there a way of defining what it's actually doing for you and how it's helping you?
It speeds up the process. To your point, yeah, I mean, look, if I had the time along with everything else, I could do that, but would I be able to do it as quickly? No. And depending on what model and what portfolio it's going into, there's always an element of human interaction, because you do get, in AI parlance, hallucinations. So there is definitely stuff that will come out and you think, why has it said that? And then sometimes you'll look in and you think, okay, I get why it's a bad data point, or you haven't picked this up. Various other bits and pieces. Sometimes it's pulled out companies and you thought, wow, that's really clever, because you work out which factor it was kind of weighting and why it's particularly like that, and the probability. And you think, actually, it is a different way of looking at things. So I'll give you an example of that over a last few years was Dropbox. So again, it relatively looked expensive at the time in a sort of 22 clear out, but actually you looked in, you could see it's still growing quickly, highly cash generative. It was really cheap compared to the other companies. And again, you just sort of saw the weighting and the factors that had driven AI's decision about why we should be putting it in the portfolio, which is ultimately my decision, by the way. So, there is always that element. It's not like I mindlessly accept stuff, but you thought, yeah, that was a really clever pick. Where I even started doing that? I mean, stock screening, as we know, is as old as the hills. So you could argue it's just a more sophisticated version of stock screening, but that would be the way I would look at it. Again, all humans are inherently biased one way or the other, and AI can be as well, but it helps that sort of independent view, that sort of base probability view of, like, have I ever weighted one factor? Am I more concerned about things? Is it because I think, it's a bad day, in terms of market performance or wherever else? And I have been influenced by the factors where the AI will sit there and go, no, actually, I think this is, a good investment and this is why.
So that was also, I was interested in where it fit in the chain, and ultimately you are the gatekeeper. You decide what goes in and what doesn't. So you're not going to say, right, the AI says this, so therefore we should put it in just because it says it. You sense check what it's saying, and you have to approve it.
Yes, as do some of my colleagues in the States, depending what asset it would be and which portfolio it'd be going in. But there is a process. Unfortunately, as much as we'd like, when something goes wrong, we'd like to march the AI out of the building and everything. I think it's going to be
make it fall down the stairs a few times as well.
Exactly, the Russian goodbye. So ultimately we have to do it, and for regulatory reasons, we have to do it as well. And say, look, it was us. We made that decision. Yeah, I'm sorry. So we got it very right in 22. As humans. So we had a view that there was a regime shift going on, and we told the various AIs to be more bearish, to kind of weight a more 1970s type scenario. And that gave us fantastic performance. We ignored the AIs for most of 2023 as they were getting increasingly more insistent that the risk return was more attractive in growth stocks, and it was expecting a rebound, and they were proven correct. And so that was one to them. And then last year was a bit of a score draw on both sides, and this year we're up a lot, where we've had a synchronized view. So perhaps when man and machine in synchronization, it works best. But that would be perhaps an example of where humans 122, computer 123, score draw, and this year we're both aligned.
But you're both doing well, which is the main point.
Yes, it's still talking to me, and it hasn't bent its screen around and trying to ignore me and not going to the pub with me anymore. So no, it's doing well at the moment. The worldview that we had was there was still a lot of liquidity tailwinds, and I think they're already turning into breezes, and obviously there's a good chance they'll turn into headwinds over the next 3 or 4 months. And given basically we're at a liquidity driven market at the moment, that would suggest that we're up for a reasonable amount of volatility and perhaps downward pressure on US asset prices going into sort of Q3, Q4.
So what are you looking for in terms of research? That it sounds like you've got it all covered with your own research and with your AI. What would you, because you mentioned looking at other research and what you might be looking for there. Good quality. Obviously, everyone wants good quality research, but I can't see a gap in what you've already got.
At the end of the day, it's just numbers, and it doesn't tell you necessarily why that number occurred. So you can see broad trends and things like that, but is it because of a corporate restructuring? Is it a one-off if there's a sensible thing there? It doesn't make any assessments around quality of management. My experience, maybe because I'm credit, is my biggest mistakes were all involved when I believed management rather than just gave them a neutral score. So again, it doesn't really make any assessment around that. I'm sure it's heading to that direction over the next few years. So it'd be that kind of stuff, or it doesn't necessarily capture industry changes. It doesn't necessarily capture why. It's that digging in sometimes where the numbers in there. Why is that occurring? Or is there some particular thing that this company's managed to find or running into? So it's that kind of deeper understanding. How do we get around some of that? Is we have relatively high portfolio turnover. So if things are not tracking in line with where we expected them to, we can swap the stuff out and it's all set up to do it. So it's incredibly cheaply. So that's how we would get around it. It's just relatively quick rebalancing. So we don't get wedded to stocks or anything like that. But it would be sometimes nice to try and understand what's going on, or is there a particular issue?
What are the headwinds that you're seeing potentially coming up?
Yeah, the US is going to extract about $850 billion over the next 12 weeks, which is a former JP Morgan CIO employee. So the CIO is also joined at the hip of their treasury. And I think it's commonly acknowledged that's probably the single biggest node in the euro dollar market, which is the offshore dollar liquidity market. That is a big number. And that is likely to cause quite significant market strain as that money gets extracted out. What's happening is basically the Federal Reserve has a bank, the federal government has a bank account, which is called the Treasury General Account. And they tend to have a certain amount of cash in there. And it obviously gets refilled periodically, whether it's tax receipts or obviously bond issues and various other things. They've been drawing that down for most of this year, which is an enormous liquidity pump into the market. And one of the features why we were still pretty bullish in March, April, because again, that liquidity pump was still under full operation. They have run that down pretty much to the minimum level, and they are going to refill it. So how are they going to refill it? Well, they can't start raising additional taxes out of cycle, so they're going to start issuing a load of bills. And it will be mainly bills. So for non-fixed income listeners, bills are very short-term instruments, notes are medium-term instruments, and bonds are long-term. So that's US arcanery, but let's just think of it as very short-term debt instruments. So the US is slowly but surely making its funding plan look much more like Brazil at the height of its EM fame, with ever growing amounts of money being rolled on a very short-term basis, and that seems to be Besant's plan. We know that because he told us that yesterday, that he's going to use even more short-term funding to roll over. We were talking about Citigroup earlier on. Citigroup, before it got into difficulty in 06, 07, also decided it was a very good idea to roll more and more of its funding on a short-term basis because it improved margins. But obviously the problem that you had is once the short-term market evaporated, which is obviously a little bit more difficult for the US government, suddenly they were high and dry because they had so much funding to roll in overnight markets and they'd frozen. So that's what they're going to do. They're going to issue an enormous amount of bills, and that will suck out a lot of liquidity in the short term in the market, and that will cause a knock-on effect in other markets. The whole financial system is just a chain, and you could see that when you were in JPM CIO. So you'd see the operations of the Fed, or even the operations of CIO itself, because it's suitably big enough that sometimes it can cause market condition changes just simply by policy, they're decided to enact. So Zoltan Posner, if you ever come across him, he's an ex-Credit Suisse employee, and we knew him before that because he was part of our regulatory team that oversaw us. I think it was Reserve Bank of New York. But he described CIO as the private sector central bank. So it is one of the big providers of offshore dollar liquidity, as well as onshore, but particularly offshore. And you could sometimes see the chain of events as they would follow through. So you think, okay, that's tightening, that's loosening, and 2-3 weeks later, you would see this enormous movement in various markets.
Would you have any sympathy for the argument that the bond markets of the world are about to meet their Waterloo? In other words, maybe a 40-year bull run in interest rates that ended conspicuously 3 to 4 years ago, and most of the world hasn't woken up to that fact yet.
Not that your question's been primed there at all.
No, absolutely. It falleth as a gentle rain from heaven.
I would have a lot of sympathy with that view. The only thing is when does the penny drop, or is it just as, the boiling the frog analogy, that it's sitting there with another year of poor performance? I think it's reached a certain level of stability now, because you've get in a reasonable amount of carry at the shorter durations. I nearly said front end of the curve, but shorter durations. I would be very nervous as I moved further out for longer duration bonds. I mean, look, history tells us. So one of the reasons you were talking about Russell Napier, so we have 2 points of common overlap. One is the CFA. The other one is Russell and I are connected to Cambridge University and economic history through different entry points and organisations. And I'm nowhere near as knowledgeable as him, but I would have, again, that history view. You know what the governments are going to do. Russell, I'm sure, has already said it on your show about there's going to be financial repression. They're going to devalue their obligations. And there's a 3-step process to that. And we're beginning to see step one now. You start to see that with the stopping of payments to winter fuel payments in the UK. There's also the personal independence allowance. Well, the government can't get either of those through at the moment, which is a remarkable piece of failure of government. But that's broadly what's going to happen. And there'll be... how you do it is, first of all, the stuff that's pretty much voluntary, for want of a better term, they will start to cut. You'll begin to see that. They are going to have to cut the triple lock at some point or another, because to really start devaluing the currency, you need to get rid of that inflation-linked component to it. Otherwise, it's pretty self-defeating. So you've already seen that in the bond market, where they moved from RPI to CPI on linkers, so inflation-linked bonds. So you've now got those two classes of bonds in the UK market. In fairness to the current government, that started under the old one. But going forward...
The other iteration of the Unit Party.
Yes, the groupthink. So, they're going to end up devaluing stuff. The big problem you've got at the moment is you've got a government that I think was very ill prepared for the hard decisions ahead of them. And I think not just ideologically, but I just don't think maturity-wise they were ready for it. And they're now in power, and apparently they can do all these things by taxing the rich people.
Well, in office, if not in power. How long do you give the? I'm trying not to be loaded, so I'll try and be as objective as possible. How long do you give the odious Starmer regime?
I think they'll stagger towards the end, but I think.
Do you think Starmer will make it through to the next election?
No, that's a different question. I'm not sure Starmer will be the Prime Minister by 2027 or during 2027. I think they will have thrown him overboard. And I'm aware it's much more complicated mechanics in the Labour Party than the Conservatives. But I think they are going to.
Conservatives get pretty ruthless pretty quickly, don't they? They suddenly forget any attempt at sort of personal loyalty when the proverbial hits the fan.
Yeah, and I think ultimately the Labour Party will, and I think you were alluding to my Substack earlier on, but if you look at the calibre of the current governing party's MPs, I think they'd be hard pushed to get any kind of job in the private sector that pay them anywhere near the same level of money as what they're on at the moment. So I think they're sort of semi-inclined to find another solution before we get to the election.
That's quite a diplomatic way of putting it.
I know some of the people involved, so So if they ever want to invite me to a drinks party again, I think I needed to be polite.
So going back to this account that the government has, is there
the US government?
Yeah, the US government. Yeah, sorry. Would that explain why do you think that the dollar might be rallying at the moment? And also, how do you track this account? Is there data online that people can follow?
Yeah, they publish the results every week, so you can see what they've been doing. And look, there's other moving parts, but yeah, that's absolutely. So we can have a long in-depth discussion about if you want bank treasury management, because I see an awful lot of stuff generally put out there that I think that's not how things work. So one of the things I would clear up is I was at JP Morgan for many years. And if you go on certain conspiracy websites, you'll see that apparently JP Morgan is always short and always pushing down the gold market. And there's a lot of truth to that. They are generally always short. Whether that pushes down the gold market is another matter entirely. But what people don't see is JP Morgan is the biggest banker to gold mining companies. So guess what? Gold mining companies forward sell a lot of their product, and they tend to use JP Morgan to do it. So you're only seeing half the trade. Does that make sense?
Yeah.
So they're forward selling stuff. Generally, they have no particularly strong view on the gold market. It's not a particularly useful asset for bank treasury management. And trust me, I tried with various regulators and say, well, look, we'd like to hold more of this for various reasons. Again, this is another side discussion, but oddly, they were highly resistant to an alternative asset to their wonderful government bonds, even though you'd point out and say, well, if it's such a crap asset, why are you holding so much of it as a central bank?
Tradition.
Tradition, yes. I just want to have billions of this stuff in tradition. So I put out earlier the year, and I mentioned in client notes that we got very long gold mining stocks, and it's done very well. But just as an aside, going back to Russell and I's sort of Cambridge link, I was at Cambridge lecture, and they have the sort of high table event afterwards, which is kind of all sit down and you get served whatever passes for high cuisine in the university these days. But I was sitting opposite a very well-known economist stroke investor who most of your listeners would have heard to. We were just discussing about, he asked me what my favourite trade was at that point. I said, actually, I think these gold mining stocks are. And he was saying, well, that's interesting, because as I go around the world, the number one question I get asked by all the central banks and various other policymakers is, how much is too much gold to have in my reserves? And that's what I think, going back to your earlier point in the dollar, I think there's two separate arguments going on. Do I think that gold holdings by central bankers are going to go up? Yes, I think structurally they will, and they will for a number of years. And there's a number of reasons behind that. And they don't tend to buy in secondary markets. They tend to buy straight out of the producers themselves for various reasons. Do I think the dollar has got one last rally left in it? Yeah, I think that's quite possible. And I think, again, going back to the Treasury General account, just if you think of it as any currency trade is two components to it. And if you think the US is effectively injecting loads of currency into the market, then automatically, yes, I would have expected it to be weaker than the other currency, all things being equal. Even more so this year, because if you looked at things like the commitment of traders, which again, for anybody that's listening, if they're really that nerdy, but it is something that we would look at, the futures and options markets basically publish who's long and what kind of client they are and what asset they are in various cases, and gold and dollar and various other things are some of it. So again, you looked at the sort of like commitment of futures, a commitment of traders at the beginning of the year, and everybody was bullish to the dollar and underweight things like sterling, which is not necessarily a bad thing over time, but everything was primed for a real dollar weakness because everybody was long. The US government, which is a major actor, was injecting liquidity. So guess what? You've had this enormous reversal. And I think now there's a high probability that that's about to reverse over the next few quarters, that actually the dollar could strengthen quite materially and cause a lot of people that have bought into that analogy a lot of problems. At the end of the day, the world runs on dollars, and it's very hard to replace it in the short term. And a lot of your listeners probably don't appreciate that. But if you kind of go into, as I had to do recently, Gatwick Airport, but the first thing you're confronted with is one of those FX bureaus. So if you're flying off to Thailand or Australia or any of these countries, most of the time there isn't a liquid currency pair in those two currencies. So what does that actually mean? It's actually there isn't enough flow between people going to Thailand and the UK to make it worth any big dealer to do that. So nearly everything gets traded to dollars and then dollars to that currency you want. So the dollar tends to form about one leg of about 80% of those trades. So replacing that is problematic. The other thing as well is just collateral management, that gold is not a particularly helpful asset for collateral management because it's big, lumpy, physical. It tends to be held in certain locations. So a lot of the stuff tends to be done is using government securities. And obviously the US Treasuries are pretty much number one in that list. So again, you have to post all that stuff. And as long as there's a certain level of faith in the US government's willingness to pay that stuff back, they'll continue to use it, partly because what else are you going to use? Bunds, well, they're not very liquid because Germany's got, 60% debt to GDP, and it's a much smaller economy. So there isn't a lot of bonds, and a lot of the ones that are out there are pretty much well held by German insurance companies, other people. French OATs are the next liquid one. So do you
plenty of Japanese government bonds out there?
Weirdly, yes, there is, but for other structural issues, other structural reasons as well, it's not particularly liquid and it's not particularly
This is the Bank of Japan owns them all.
Yeah, exactly. Bank of Japan owns loads of them. So actually, you start to fall away in terms of liquidity pretty quickly. So yeah, could the Americans blow up the financial system and wreck the dollar? Yes, but change takes an awful long period of time. And I'm sure Russ will be able to tell you this, but in the case of sterling being replaced, it took 2 world wars and about 30, 40 years for it to occur.
2 world wars and 1 World Cup.
Did the World Cup accelerate things? So, yeah, so I think replacing the dollar would be hard short term. And I think there's a lot of people that are net dollar short.
So you mentioned that you think gold will go up over the next few years, and there are some reasons behind that. What do you see as those reasons?
Well, they're going to devalue the currency, aren't they? So the big question comes back, is gold really going up or the currency going down? But look, there's too much debt in the Western world. Too many countries over the last 30, 40 years thought they were able to basically run these very loose fiscal policies. And I think it's all coming home to roost, to Tim's earlier point. So I think the bond market is going to have some issues. And I think not as many issues as a lot of politicians are going to have when they realise that they've basically run out of road and they are going to have to impose much more aggressive and horrible policies on the population, most of which will probably be around spending rather than taxation.
But in the short term, with the dollar rallying, do you think that the gold price and perhaps precious metals will come off?
I'm not really a short-term trader, but that's a distinct possibility. Let's just put it like this. I'm happier with the structural trend there. The other reason, why did I go for the gold mining companies rather than gold itself?
Right.
So gold, to my mind, is just a behavioral asset. So it's very hard to value it on a standalone basis. It's what value humans put to it. Gold mining companies are a bit easier. So for a couple of reasons, the earnings tend to lag. We discussed one of them. Gold mining companies tend to forward sell and often forward sell quite aggressively. So even if the gold price goes up, it takes 2 or 3 years to be reflected in their actual earnings. And often you get that delayed pickup in the share price afterwards. You've also got the advantage that they've got enormous operational leverage. So the gold price going up actually can magnify the level of return far more in the companies themselves. But for anybody listening in and wishing to replicate that, I would caution that you need to run a portfolio when you have that approach, because you want a combination of majors. So that is the sort of big blue chip companies that produce a lot of money year over year, produce a dividend year over year. But you want a certain level of junior miners because they act more like options. So they go from being possibly loss-making to marginally profitable to enormously profitable in a very short period of time. And you are talking about hundreds of % return in some of those cases, but they are very speculative. So again, you want to have a balanced portfolio approach to that.
So if you could only own one asset for the next, I mean, it's a completely artificial question, but if you could only own one asset over the next 5 years, so what would be on the short list for that one asset?
I think gold's a fairly decent one. I'm not a gold bug, by the way, but I think it's that point of the cycle. I think real estate, if quality real estate is something that's worth looking at, but I think there needs to be a bigger shakeout in the market before we get to that point.
Silver, do you like silver?
I suspect it gets dragged up with gold, yes.
Because the thing I find intriguing about the silver story is that unlike gold, which tends to be hoarded, silver actually gets used as the most conductive metal, so it's an essential part of the modern digital economy. And the fact that the physical market's been in basically deficit for the last 5 or 6 years suggests that, notwithstanding the best efforts of certain banks who will have to remain nameless, that market at some point is going to explode higher just due to supply and demand.
I think that I'm not a precious metals expert, but I wouldn't argue with that view.
Well, it's only because it's also been money. So it's like been like poor man's money alongside gold for the last several thousand years. So
yeah,
it reverts to its sort of monetary-like status then. But no, I mean, in addition, do you have a view on crypto?
No, but if you listen to the podcast, my co-host Tom is much more of a crypto enthusiast than I am. The issue I'd have with crypto is that I'm not sure we've seen the final stage of it yet, and also we've only seen it in a very loose liquidity environment. I'd like to see it in a tight liquidity environment. And the other thing that I'm sure, again, Russell would mention, but the history of private money is long and not very illustrious. And I would like to see it go through a proper tight cycle just to see where the thing ends up. The other thing as well, if it was really successful, it's not really in government interest to let it to be really successful because they want a monetary monopoly. They don't really want to be competing with something else in their economy. Now, what might occur in the short term is I think there's a reasonable case that you might see almost like a South Seas bubble or Mississippi Company type effect where they potentially use crypto. And you've heard Besant talking broadly along these lines about as a way to consolidate their debts by generating a speculative asset that sucks in a load of retail money, and they basically consolidate their debts into that asset. The trouble you have with, as you'll see with both those cases, when it happened, it was certainly in the case of the British, a fantastically successful debt consolidation exercise. But anybody that was long at the top got absolutely crushed, which included Isaac Newton. And in the case of the French, it triggered a outright revolution because people were so upset about losing that much money. So I think we're in a dangerous world where we might see some very old ideas potentially coming back to play, and I think crypto potentially has a role with that. So no, I'd avoid it. I know lots of people that have made an awful lot of money out of it. I have studiously avoided it since at least 2011, 2012, when many of my colleagues were saying I should get involved. So that's all you need to know about what I know about it as an asset class. So
you could say people have made money out of OnlyFans, so it doesn't mean we should all have an OnlyFans account.
This is true. Apparently, OnlyFans is technically the second most successful British tech company of all time. I don't know why they don't celebrate this success more in the British media.
We're not allowed to. You need age consent first, and everyone's on VPNs.
Yeah, I as you know, I've just come back from being abroad, and I came back, and it was a bit of a shock about how much problems there were now on the internet. And my Twitter feed, which maybe just suggests more about what my Twitter feed was. I didn't realise it was so racy, but there's loads of stuff that's now blocked, which I think half of it was political. So anyway.
I mean, you mentioned the political problems. Do you think that there's any possibility that actually the whole nature of governments and even nation states may be transformed over the years to come? Because I just sense that things are close to a boiling point here in the UK, and probably not far behind in let's say most of Europe. No.
Yeah, I'd agree with that. So part of my trip abroad was also just to test things like Starlink, just to see how effective it generally is. So for anyone that's listening, that's the new Elon Musk satellite platform. I mean, it's incredible. I mean, for 200 quid and 90 quid a month, it all fits into a backpack with your laptop, and you can pretty much operate wherever you want in the world. And I think that Web3, which is again the next iteration of the web, and again, we're in early days there, but it starts to make it very difficult for the nation state to operate as it has done, because you can potentially sit wherever you want. You can make your money in another location, and there are ways where none of this potentially has to be paid to the taxman, legitimately, I should add. So, yeah, I think they've got a number of problems coming. I think, though, if again you look back at history, most people don't really have that option. So there will be an awfully large amount of people that are stuck and will have to do those things. But then if you actually look at what really drives the economy, and it's usually the top 5-10% of the population, not necessarily by wealth, but they are the ones who tend to be very, very high value add. And you've got a high chance that these people might not have to be in your country anymore and operate somewhere else. So yeah, I think we're getting close to a point where there's going to be quite a lot of political changes.
When there is a big correction in the market, how big do you think it could be? Would you be using the word crash? And if so, how far away do you think we might be from that sort of situation?
If I knew that, I'd be sitting on a beach and running my portfolio for there. Wait a minute,
We don't know that you're not, Ben.
Yeah, exactly. You might be on a beach with your Starlink.
I mean, you may have just tuned out the wave, the sound of the surf in the background.
I think there's a chance of more than a 10% correction before the end of the year. I think that's probably a base case. That I wouldn't define as a crash. I'd almost define that as a normal order of business. I would be surprised if we managed to get through the next 18 months without a 20%, perhaps more, movement in equity markets.
How did you play the tariff crash then? Were you buying more? Did you get out before? What was your strategy?
Yeah, we just de-risked going into it because nobody seemed to be listening to what Trump had actually said. And we didn't take a big de-risking, but we sort of ran a relatively lower beta, so less volatile than the market portfolio with a bit of cash. The crash started to unwind and started to unfold, and we just decided to take advantage and buy in. So it might sound Harry hindsight, but if you go back from my LinkedIn, you'll see that I talk about 1 week before the crash starts, saying that I don't think the market's listening to what is being told, and it's about to have a bit of a surprise. Perhaps what might be more useful is, look, one man's actions can influence the market, but not necessarily over time. And again, going back to that commitment, the trader's position. So first of all, starting off as you're probably beginning to guess, I've got a liquidity-driven view of the world. The liquidity was still very strong, and it was going to continue to be strong because the Fed had already told you, or at least the federal government had told you, it was going to continue to draw this down. You knew that they were all aiming towards getting the big, beautiful bill passed. So, there was a high chance of Trump basically backing down because he needed pretty much every vote to get that through both houses. And again, whether it was Ukraine, whether it was on Israel, he basically paused and delayed everything. Well, he politically had to do that. And then you had the commitment of traders, and you saw that actually lots and lots of people were short, very speculative people in the most cases who tend to be the weakest hands. So you had all the conditions in there for a really strong, big rebound. If you look at things now, Trump has got his big, beautiful bill through. I don't see any other particular, I'm not a US political expert, but I don't see any other big piece of legislation he needs to get through until the end of the midterms, which is next year. So I think he's pretty much unleashed about what he wants to say, and you're beginning to see that with some of his actions in the markets. You've got the rebuild of the Treasury General Account occurring, and you've got the US funding requirement coming up. So again, plus you're beginning to see from positioning, people are much more bullish than they were previously. So from my probabilistic view of the world, things are beginning to line up at the moment where I think you've certainly got the case for a very bumpy ride over the next 2 or 3 quarters. If inflation does resurface and it forces the Fed into wider actions, or the bond market begins to realize that they are going to be the patsies in this big trade-off and yields start to rise, then I think that is definitely the right conditions for a much bigger sell-off.
Do you have a minimum company size that you're willing to invest in, or would you put a smaller amount in, say, it's something, a smaller stock that's not necessarily got the capitalization, but you think it may have excellent chances of performing very well?
Generally, no, because the problem that we would have is just liquidity. So even a relatively smaller set of funds, there's always a minimum point where you look at the bid-offer spread and you think, that is attractive, but I have to put it in there in a certain size. And do I want to start, compromising the model or compromising sizes? And there's always a chance as well, you might have a large series of outflows. Things go wrong. That is the nature of the universe. And do I want to be stuck with a load of illiquid stuff? That's something that I'm very interested to look at. If you look at this, without going to the maths of chaos and what that means, but if you look at what you would want to run your portfolio at the moment, you'd want to have a lot of optionality. You'd want to have stuff that's readily, able to liquidate. You look at what a lot of the other investors are doing at the moment, piling into still private equity, but also private credit, which is somebody with a credit background is even more of interest to me. It really isn't what you would want to be doing at this point in the cycle, and yet there they are. So I think people are about to discover why they talk about the liquidity premium or the illiquidity premium in markets. And I think that's going to be a trouble for people, a problem for them over the next 2 or 3 years.
So you mentioned the word cycle. What are you defining as a cycle? Do you mean over this year, or do you look at longer term timeframes?
Can I come back? Because as a regular listener, just to prove that I do, I listened to Grant Williams a few weeks ago, and he was talking about the fourth turning.
Yeah.
And he was saying everybody said. So I'm not disagreeing with him, but if I just explain my much more probabilistic view of the world, there's always cycles. There's just series of cycles. There's shorter term ones, more medium term ones. Some of these are observable in markets, but the problem you have is there is no evidence of one overarching cycle, which is effectively what the fourth turning is telling you. And so the question you have is, do I think that we're at the end of a shorter term cycle, a liquidity driven cycle? Yeah, absolutely. I do think we are. I think, is there some evidence that there is a longer term institutional cycle, which might have been linked to Tim's earlier point about interest rates falling for 40 years and now they're potentially going to start rising for the next 30, 40 years. I think there's some evidence with that too. But bringing in and I know this is a general podcast, so I'll keep it simple, but in the maths of chaos, they call them attractors. So the best way to think of the maths very crudely is like a pinball machine. So I fire the pinball up. The ball I know broadly is going to come down. That is an attractor. So your primary attractor is gravity will drag that ball down. You cannot plot that path. You cannot plot what happens when it bangs into some flipper or some other kind of interaction and stuff. And the problem that I kind of have with the whole fourth turning argument is it's very deterministic, which is not how the world works. And we know that because we've got the maths, as opposed to how the world genuinely works, which is probabilistic. So just going back to that point earlier on, I think there is a case to be made about the primary attractor, about there's a lot of renewal, there's a lot of problems coming to a head. But I think you've got longer term and short term cycles all coming to a head at the same time. Another one we're not talking about is technology. So again, talking about somebody else that talks about cycles, there is Carlota Perez. She's an economist, and she talks about the economics of technology innovation. You look at how she would describe things, we are at the end of the first stage of the cycle. So what's likely to happen is there's a very good crash that's likely to happen in AI over the next 2 or 3 years, probably around data centers. And that's very unfortunate for the investors, but actually it's a very positive thing for everybody else because we've just had what they call the installation phase. So what do they mean by that? Just think of the railway crash in the 19th century in the UK, too much capital. There was only so many lines that were going to make that much money. But actually the railway lines got built. So the investors lost their shirts in the whole thing, and certainly late stage investors did. But actually suddenly the railways are all in there and the traffic comes through over time, and it's other companies and investors who benefit from it. Look at the internet bubble. Again, a lot of the telco companies thought they were going to be the big winners, spent an enormous amount of money putting in fiber optic cable and various other things. Actually, all the demand did come through. In fact, in many ways, it was understated, but it took years and it was a different set of investors that benefited from it. So I think, again, on another cycle that you've got at the moment, I think we're getting very close to the end of that AI cycle, and we're going to find that it was brilliant that you built all these data centers and they're dirt cheap and stuff, but I really don't think you're going to be getting your money back on them. So I think that's one cycle coming to the end. I think the debt cycle, we're about to see fiscal dominance. That's definitely coming to an end. And I think there's a good case that the political cycle is also beginning to shift, and the current embedded uniparty, as Tim put it, bunch of politicians are ill-suited for what's about to come next.
Interesting time to be alive, isn't it?
Well, being alive at any time is hopefully interesting.
Yeah.
It's better
every day above ground is a good day.
But yeah, it's an interesting time to be alive. I think there's an awful lot of things that are coming to a head at the moment, whether it's short-term cycles, medium-term cycles. But I would throw in that probability and chaotic events can occur. So remember, going back to that pinball analogy, chaos doesn't say anything can occur. It just means that it's very hard to predict that how the pinball will fall. It's not like the pinball can suddenly defy gravity or escape the machine or anything like that. So there are still rules that govern their operation. It's just you cannot predict the path it's going to take, and there are independent events in there. And the other thing that chaos tells you as well, events act on themselves. So, something happens, you get a massive overreaction. So a good example of that is COVID. You get COVID occurring. With hindsight, it now looks like a massive overreaction, but that will trigger another series of events, which again just accelerated the problems that we were going to have in the debt market anyway at some point. It might have been 10, 15 years away. Now it looks like it's more likely to be the next 18 months, 2 years.
So when you're building your models, do you use these attractors to say, well, look, I think the market's either bullish or bearish, and then let the model decide what picks would act towards those attractors, as it were?
Yeah, the model kind of tells us if the market's bullish and bearish. What might be more useful is do you think it's justified or not? So any big movement needs a lot of people to be bullish and stay bullish for quite a long time. The model might just give you a guide that whether you think that's justified or not, and where do you think the valuations do it. So something that I do, which is a bit of a joke product on my Substack, and please don't take it as an investment model, and I'm sure my compliance officer would tell you that, but I put a flavour of that on there under something called QuantCat, which is this synthetic cat that gives you basically probabilistic view of the world. And just because I'm a bond investor, we trained it to reply in the fashion of Blofeld's cat, because who knows more about liquidating bonds than Blofeld?
See what he did there.
I know, it's dreadful, isn't it? So, but if you have a look in there, QuantCat, when I publish and I have time to do sort of write up for in there, and it doesn't mean it's right, because I often will say, look, this is actually where I'd question it if I was you, but it kind of gives you a flavour of that probabilistic investing, and it kind of shows why it was bullish in March, April, similar to the other stuff that we use, and why it's getting a little bit more concerned now.
Interesting. We'll definitely have to get your handles before the end of the show. Obviously, Tim mentioned your Substack was a great read, and I'm really looking forward to having a look at it. I was just wondering, what's your have you read Gary Stevenson's book, The Trading Game?
No, I haven't. But given I know some people in the market, my starting point was, since a lot of it else doesn't seem to stack up, I'm not sure why I should delve into his economic theories.
Okay, that's exactly what I wanted to ask you about. It was another way of putting it. So, yeah.
So since his basic bio didn't seem to hold true, I wasn't sure I should listen to anything else that was being suggested. So I haven't read what he's talking about, and I wouldn't be an expert, but I think it's fair to say there's quite a lot of skepticism in the general financial media about what the claims he's made when he was at Citigroup.
I mean, I have to say, when I first heard about him and when I read I really enjoyed his book. It's extremely well written.
That's what I have been told, actually. I have been told it's extremely well written.
It is extremely well written.
Though perhaps not by him.
Well, I would be very surprised if it, to be fair, how can I phrase this? When you hear him speak and then you see what's written, it doesn't match at all. So I would be surprised if he had physically written what he said, and it's not because he's got a sort of East London accent, although that's partly it. It's just the words that he uses, when he describes going to a dinner when he first started at Citibank, and he was taken out. I mean, there's some very endearing little stories in there, and he was talking about how, he just started there and they took him for lunch at this really expensive place. So he got out and got as much money as he could out of a cash machine because he thought he'd have to pay. And then he talks about the brokers coming in, and he said one had a contrabrass voice. And I was thinking, you wouldn't use that sort of word. That's really odd. So little bits of it, and some of the parlance did not fit in with what I thought potentially he would be writing. Also, an incredible memory if he's remembered all of this stuff. And on top of that, sometimes it switched into Americanisms. I noticed later in the book, which was kind of weird. Definite Americanisms. So there was, stylistically, I could see some, but having said that, I really enjoyed the book, and I thought what he was saying was extremely interesting. His angle of what might, he's talking about cause and why he thinks things will happen in the way that they will happen. He's really describing the Cantillon effect, where when the government gives money, it just goes to rich people, and rich people buy assets. That's kind of the summary of everything that he said. Now, all the other stuff about whether he was the biggest trader for Citibank or whatever that might have been. Anyone who trades stirs knows that there's very little volatility in stirs. So you have to take a huge position in order to get any meaningful position in them. So you could, like an individual could have a position of 250,000 in a stirs trade that is obviously, if you had that in Apple stock, that's a big position. But in stirs, because they move such a tiny percentage, it's not a position. So you have to take millions and millions to get a meaningful position. So if you're talking about the biggest trader, he may have had massive positions, and that might be reflected in what he's talking about bigness. But other than that, I mean, his market calls have been generally kind of right from what he's said and what's happened, i.e. he's talked about asset prices rising and the FTSE rising because there's been more money being pumped in. And that's why what you're saying here is so interesting, Ben, because if you're saying that money and liquidity is going to be taken out, that would imply that the opposite would happen very quickly. But the question was, like, I was just curious because there's the jury's sort of out now from somebody who I thought was being quite honest. Not that he's being dishonest, but maybe just sort of overblowing slightly the situation. He's obviously very popular, and he seems to be on a crusade to help people. Which so I guess his heart's in the right place.
Not the extremely wealthy contingent of the population. I don't think he's doing anything to help them.
Yeah, maybe. But does he have to do that? Can he not just do it with his time and try and educate people? I don't know. Is that what should he do? I mean, I guess he's written a book and he's trying to get his message out. But I mean, he doesn't spend any money from what we can see, which is a kind of strange thing. But I think he's quite a peculiar chap, to quite honest. I mean, if you look at Warren Buffett, he's a very peculiar chap, and that's why he is the way he is. You know, you got from one of the strangest things about the book was how he didn't seem to spend any money. And I was just really baffled. Like, you know, he got this huge bonus and he was talking about his girlfriend buying a sofa or something. And it was like, what are you doing? You know, so he doesn't seem to ever spend money, which is very odd. And I think that would have helped. But anyway. So,
a lot to unpack this. So the first thing, I'll read the book. I've been told it's a good read. It's just that he, to my mind, joined a long tradition of people that said they'd done something, or let's just say there were some question marks over it, which includes our current Chancellor, who apparently was an economist at the Bank of Scotland, which for anybody that was in the city would remember there was two economists at the Bank of Scotland, and you weren't one of them. And then there was the Tory party hopeful that told everybody that she was the CIO of Invesco, which again, in a small world, no, you weren't. And includes our former Prime Minister, who famously was at Goldman Sachs, yet mysteriously left after 3 years, just when they do yank and rank. And then went on to apparently make a fortune in the city, yet somehow seems to have not graced the FCA register in any kind of key form that would suggest he managed money, other than he was a partner temporarily at the Children's Investment Fund, which again would lead to several holes in the commonly held narrative about what financial genius he was and how he ran a hedge fund in the city.
But anyway.
So to the Cantillon effect, yeah, I agree with it. I think that's exactly what's been going on. And so, yeah, we're doomed to repeat a whole load of mistakes that happened in the past. So I'd broadly agree with him on that. I actually have some sympathy for him on not spending money, because for a lot of city careers, particularly traders, it's a bit like football money, isn't it? You earn a lot of money, but the banks tend to turf you out in your 30s, or you even turf yourself out in your 30s. And you're unlikely to get those kind of level of earnings ever again. So it sort of makes some sense to provision for the future rather than treat it like it's a permanent income theory.
Yeah, so, but this was extreme, though. To be fair, I mean, it's like he was talking about being in an interview, and he looked down at his trainers, and his trainers were just completely worn out. And we're talking about spending no money.
Yeah. But then, look, we all work in finance. There is a fair amount of auditors or people with unusual personalities get attracted
for sure. Yeah.
And given I've got a Substack where I've created a cat that speaks like Blofeld, I'm probably the last person to criticise anybody about general oddness.
Yeah. To be fair, glass houses and all that. Yeah. I mean, I don't. Yeah, I think you could say that about all of us. To be fair, but yeah, good point. But yeah, obviously we want to have you back on the show, so I'd really like to know what you think of it. But it was more the economics, really. I mean, I suppose the Cantillon effect is kind of what he's talking about, though he never mentions it. And the first part of the book is, again, really interesting about how he got his job, he got his break from a very poor background, which apparently that is definitely true, and that's been verified. So anyway,
yeah, to his, as you describe his broad thesis, yeah, I think that's exactly what's gone on over the last few years. You basically, interest rates peak mid-1980s, then they start their long, slow decline. That allows more and more leverage to go on. Then we make a whole series of really bad sort of trade deals in the 1990s. Because trade doesn't operate like people think it does. That includes, to my mind, the European single market, but also NAFTA. That allowed for a lot of enormous amount of outsourcing of jobs. I saw even Yellen, who was previously a very big booster of NAFTA and, WTO. Now she talked about in her final days about, I think I made a mistake. I wouldn't look at it these days. Well, yeah, that's fine for you, Janet, but about 6-7 million American manufacturing people lost their jobs. So the problem was, again, that allowed the perpetuation, to my mind, of rates coming down, because you had a couple of things at that point. A lot of the volatility and cyclicality that comes with manufacturing ended up getting outsourced to Asia, but it also had this deflationary pull on asset prices. Then you had the whole gross stupidity that we're managing the economy to one inflation rate. Well, wait a minute, there's sort of 2 or 3 baskets in there. And given you've got this enormous goods basket being dragged down, shouldn't you really be looking at asset prices and various other things and how people live their lives? So that was kind of a mistake that we had in the 1920s, where again, they didn't necessarily look at, asset speculation. So I think you've had a whole series and combination of those factors dragging us down to that ever lower level, and it's all beginning to unwind. So yeah, the tariffs and the trade impositions will almost certainly fuel a certain level of inflation. That I think will probably make things sticky. I think the enormous government debts will almost certainly start to cause rates going higher, as much as Trump might want to talk down the front end of the curve. And I think, that process could be quite messy over the next few years as it unwinds itself. But it might take 2 or 3 years. So I was chatting with my risk manager, who also comes from the East End, and I take him very seriously. But he was just saying, but we used to work together at JP Morgan back in the day, and he was saying, but, we were predicting this massive banking crash from at least the end of 05, beginning of 06. And it took another 2 or 3 years for it to unfold. So things can take their time to kind of go there. But the direction, the path, none of it is positive. So, and look, crashes are an inevitable part of the market. So there will be one, and it will be a very, very big one at some point. It's just predicting that is going to be problematic. But I certainly think a lot of the stuff is beginning to build up now. Those, as I said earlier on, without repeating myself too much, but the key factors that drove the market to ever new lows are now reversing. And that would suggest that you are going to get a much more volatile and problematic environment. And we've got a bunch of politicians that think in linear ways in a world that is definitely non-linear, and it's bound to go non-linear quite quickly.
When it comes to measuring inflation, what would you say? There's Trueflation, which I don't know if trueflation.com, I don't know if you've heard of them. Tim and I were discussing them on the last pod, where I think they gave a below level of inflation, or was showing that it was actually weaker, which surprised me. What do you think is a good way to do it? And have you heard of Trueflation?
I haven't heard of Trueflation. Or put it another way, I've heard Trueflation. I'm not sure anything more than that, so I wouldn't be an expert. There's a guy called Tim Morgan, who used to be chief economist of one of the brokers. And when I mean the brokers, I mean the IDB brokers. So like, the Tullett pre-bonds of the world, NICAP. I can't remember which one he was at. But he wrote a paper, God knows, must have been about 15 years ago. And his starting point was inflation is kind of who you are, because it's very much depends on your lifestyle. So he came up with 4 or 5 distinct cohorts for the UK. And actually, depending where you are in that cohort, actually is how you feel about the world. So again, if you're sort of old and you're not having to commute in every day and stuff like that, you're much less sensitive to some of these pushes. But if you're much, earlier on in the process, and you might be looking to buy a house and various other things, you are very sensitive. And then to tie that back into politics, well, it depends on which cohort matters the most to get you into power for most politicians, rather than what it is. So I think measuring a single number is problematic in any case. And again, how you feel about it, to go back to Tim Morgan's point, sort of depends with who you are, because your lifestyle may well be quite deflationary or very inflationary at the moment. I think you can see from the States, for the average person, it's pretty inflationary and they're very unhappy about it.
That's a great answer. I've never heard that before. Have you heard that, Tim?
The Tim Morgan thing sounds like a great idea.
Yeah. It's like a relativity. It's like depends on where you are, which is it's one of those things that's so obvious now you've said it, but why didn't we ever really think of it? But I mean, of course, we understand that it's a basket and it depends what's in the basket. But what I thought Trueflation were doing was looking at what the government used to use as a model and maintaining it, rather than just trying to decide that things need to fall out because public sector pay is linked to it, and therefore it's within their interest to show it as being, for political reasons and for financial reasons, as low as possible. So I just thought, well, a more honest, independent measure of inflation might actually tell us where we are. In some ways, the stock market does that because it will reflect inflation, and that's partly why I guess it's gone up, and obviously gold and precious metals. But it's like there doesn't seem to be an index that says this is true. Well, unless true, I haven't looked into Trueflation that much myself either, but I would expect bond markets and prices further down the curve to be reflecting it, or be a good measure of it, because obviously when finance is involved, you'd expect them to be priced correctly, but as I'm saying it, I'm hearing it out loud, that's not necessarily the case.
No, and I guess, look, there's technological changes, how we live our lives are different. The other thing that kind of, just on the whole point of the sort of inflation measure as well, is other than it's sort of a single number. You've also got to reflect that it's not just the technology basket, it's also society's different. You had the baby boomers in the 1980s. So again, for them, and probably where they were in the curve, inflation, and where inflation is most sensitive, was more problematic for them. At the moment, we've got generally an aging population. So for them, it's probably less problematic. And then you start to get into the modelling adjustments of, well, actually, am I going to adjust this for the average population? Well, what does that mean? Is that by cohort, or is it by, some other kind of metric? So I think it's sort of problematic, like I say, coming in with any one number. It's like Charles Goodhart, who basically ran the Bank of England, and chunk of the Treasury. So he was their main sort of link man between the two in the 70s and 80s, and he's still around in some retired capacity at the LSE. But you've got sort of Goodhart's law, and it's like the moment you're running something by one number, that number instantly becomes devalued. And it's great that the government's decided to come out and perhaps fix things to its own ends, but it doesn't change the reality of how people are going to feel about things. It isn't going to change people's sentiment. You can go out and say, great, tractor production's up 200% this year, or whatever metric they want to use.
So we don't have any farmers left.
No, exactly. Well, we certainly won't have by the end of this process. So look, solar panels basically need to go somewhere, Tim, and we don't need to eat. So again, they can fiddle around with it, but ultimately sentiment will come through, and it won't change the political reality or the social reality of how a large cohort of people will care about things.
Have you read The Fourth Turning, Tim?
I've got a copy somewhere, but it's one of those books you buy and then just leave hanging around till an act.
It's not the best book.
It's not the best.
I was going to ask Ben, have you got a copy of 180 Degrees by Fergus O'Connor Greenwood?
No, I haven't. If you recommend it, I will read it.
I recommend it with reservations, because it's probably the most intriguing book I've ever read, but it's also the most in parts upsetting or challenging book that I've read, because the subtitle gives you the whole deal, which is basically unlearn the lies you've been taught to believe. So the central thesis is that basically and we'll draw a veil over exactly who they are, but listeners can infer they've been basically lying to us forever about basically everything. So it's food for thought. And he's also the author's very critical of the financial system and the way banks create money, or create money out of thin air, which is how it actually happens.
I can confirm that I haven't done that. I know it sounds bad, makes me a bad person. I've also been to Davos as well. So
it's all coming out in the wash now.
Exactly, I'm one of them. So I only came on these guys just to see if there was any minute for a last minute reprieve for the two of you, but unfortunately there's no.
No, we're off to the gulag tomorrow.
So who were you partying with? Who was cutting a rug and shaking a leg at the local disco?
Yeah, so the first thing is what kind of lanyard you get denotes what you're allowed to go into. But honestly, it's having seen, I don't know, whatever you want to call it, the WEF close up or the Forum close up, or indeed the Illuminati or whoever else you want to describe. It's a lot less impressive than you think it is. And a lot of Davos is sitting in a meeting where somebody like Sean Penn comes in and screams about female rights or something like that for about 20 minutes and then leaves for some party. So, yeah, it's an awful lot of back scratching, and if you think that's an alternative world government, I'm afraid to say I'll have to disappoint you on that one. So, is it a fast unraveling grift for old Klaus Schwab? Yes, it is. So, I don't know if you've been following any of that he's finally been caught for money extraction and various other things like that. So that's what it always looked like to me close up. And it seems to suggest that that's what it was used for. So there we go.
There we go. So
maybe the reality is a lot more depressing in that actually, there's no grand master plan, which is pretty much how the world would actually operate. There is no grand master plan, and actually a lot more of it's random. And having seen at least one elite firm very up close at a senior level, you've got to remember there's always different power factions going on. There's different worldviews. There's people that will absolutely maximize to their own benefit, and their own benefit doesn't necessarily mean what's the best thing for the firm, let alone those collection of individuals known as shareholders. So I would be skeptical. What I do think is it's an awful lot of groupthink for people that depend on those relationships for business, and more importantly, finding other jobs and roles. And again, I put it on the Substack because it's a long forgotten report, but it's worth skimming through. But it's basically the IMF's investigation about how did they screw up so badly over the Euro crisis bailout. One of the things they basically tell you is all the same people, effortlessly moving between the EU, the ECB, the IMF and stuff. And they had enormous conflicts of interest, and effectively they maximised for their own personal benefits and their institutional networks rather than what was necessarily the right thing for the wider collection of IMF shareholders.
It's almost as if the centralised state isn't the best allocator of capital. That's better done by private individuals, but let's move on.
That's a shocking view, and that will never get you invited to Jeremy Corbyn's new launch party, my friend, with a view like that.
Well, have they arranged a name yet, or are they still arguing about the name? Your party. No, it's your party.
I honestly think the more you go back and watch things like The Life of Brian, you realise that actually it was just a brilliant, incisive view.
It was prophecy. It's prophecy.
Every 40 or 50 years. So, yeah, do I think there's going to be, if you're going back to the Cantillon effect and various other economic cycles, there is a lot of economic history and history in general that will tell you, yes, you are about to get, I think Peter Turkin wrote a book about elite overproduction, but that's effectively what he's talking about. You are going to get a splintering of the elite, where there is going to be different views. There's too many of them for the jobs that are available. The economic growth has been too slow to get these people these jobs. So there is going to be an awful lot of infighting. None of that's new. I think Machiavelli describes it as the battle between the foxes, the lions, and the sheep. And it's always the lions are the ones in power, the foxes are the ones who want to gain power, and the sheep just get run by whoever's in power at that kind of point. So I think we're reaching that point where you've got that elite splintering going on, and you are going to have a rise of new populist type powers. Now, it might be a push to describe Jeremy Corbyn as a member of the elite, along with whatever fruitcakes he's managed to drag along.
Sultanas.
Yeah, sultanas even. So, but I can't see any left-wing solutions to what they are talking about at the moment. I mean, the state is broadly, to my mind, too big, which might be a political view. There is going to have to be some kind of material expenditure cuts in real terms, even if it's not in nominal terms. If we were at a much lower debt level, much lower taxation level, I could see room for potentially left-wing solutions to things. But unfortunately for them, I think where we are in the cycle, you're looking at something more aggressive, normally associated with right-wing. So, I mean, look, to my mind, the easy win is a lot of deregulation, which should by its own right start getting the economy shifting. But we seem to have a government that's relatively resistant to that.
So if you had a member of family who was coming out of education, traditional education, but was interested in the markets and doing what you were doing, what would you recommend they read to learn about how the markets truly work, or what pathway do you think they should take in this day and age?
That's a good question. So I have to phrase it carefully because some of this might border on something my compliance officer might not approve of. Starting off about getting into markets, the first thing I would suggest is IG Index. Hear me out here, guys. IG Index offers a free paper-based trading account. So you go online, they give you an alleged 10,000 quid to invest in markets. And it's all paper-based trading to kind of get you used to things. They have a very good set of short videos and instructions and talking about some classic trading areas, momentum trading, all this kind of stuff. So my opening suggestion for them, and this is what we do with our interns, is suggest actually watch through those, and why don't you try a paper-based account for a while, and let's see how your first in economics actually tries out in the real world. And oddly enough, it really works.
Yeah.
So that would be my first starting point. It's just, look, it's free. Don't do it with real money, but losing money and understand why you're losing money and what actually works, and things like negative carry and various other things, is a very useful starting point for them. As you've probably heard repeatedly from me, and we didn't discuss the other element, but I have a liquidity-based view of the world. And I think probably the best book I've ever read on that, but it's not an easy read, and I don't necessarily recommend it to people, but it would be Gordon Pepper's Money, Credit and Asset Prices. Pepper was an economist in the city. I think he lectures in some capacity now. But
he's also one of the speakers at Russell Napier's Practical History of Financial Markets course.
Okay, so Gordon, like I said, I think straddled both camps. He was an academic and he worked in gilt brokers for a very long period of time. So I think his view of the world and actually what drives markets most of the time is actually very accurate. And that's actually how I tend to see things. And that's why you kind of quite often get these extreme valuations and stuff that seems to have no basis in fundamentals for a long period of time, which then gets to the final part. I look at stuff around behaviorism, because we're a pack of monkeys and we tend to do things without necessarily thinking them through. You were asking earlier on, Paul, about what does the AI do? Well, it tries to reduce my level of improvisation around portfolios. So I would also have a look at stuff. I think James Montier wrote a really good book several years ago about behaviorism in markets, and I think that's really useful as well. And I've alluded to it as a proxy, but commitment of traders reports. So again, that sort of tells you how the market's feeling about things. There's other ones. There's obviously the Merrill Lynch survey, which I'm a little bit more skeptical about how accurate that is, having filled it in myself on many a hangover-ridden Friday morning. So I would say, that's what I would start off. I'd re-anchor it just to think that these are systems of humans, and this is, this is the fundamental plumbing. This is how humans tend to react to things. This is how things tend to go around. So for a markets-based perspective, that's how I'd look at it, and then tying it up with actually something practical, so you can actually put your theories to work and see what works and what doesn't work, and all that kind of stuff is very useful. I honestly think the other two things that I always tell them, if you're interested, I'll post some of it up for you, because I think you have on your, at least I'm an Apple user, my apologies, but you quite often have links afterwards. So I'll post a couple of slides from our intern pack, and it's courses that we get them to do. So I think the Oxford University series of lectures on critical thinking is really useful.
Oh, brilliant.
So that is, again, because a lot of them come out of university and they've learnt stuff, but they don't necessarily think about stuff. And also passing a complicated set of exams isn't necessarily the same thing as operating in the real world. And I also think something that's worth doing as well, there's a course, if you do it within a certain period of time, I think it's free, but it's a good intro. But if you don't understand how much AI is going to change the world, you don't understand what's about to happen. So it is going to have an absolutely transformative effect. So there's a course by Vanderbilt University, and it's called Prompt Engineering. And I think that's a very good shorthand to getting into some exposure to AI, some kind of exposure to model building using AI, which is much simpler than it sounds. Certainly for me that learned in the days of BASIC and then machine code. And And again, that I think is a very useful exercise for them. If you want a wider thing about where AI is going, I think The Coming Wave by Mustafa Suleyman is a really good read. He was one of the 3 founders of DeepMind. And some of the stuff that we've seen in the last few months are exactly in line with where he predicted when he wrote the book about 18 months ago. So I think I would get ahead of the curve there. The other thing you've got to remember is any technological sort of innovation like this will be disruptive. Usually they do create more jobs in the medium to long term route, which you see from another book called, is it Russ Robinson and Asa Margalu, who's just won the Nobel Prize for something else, but it's Why Nations Fail. That's to my mind, a remarkably readable book, but it explains why certain systems work, why certain systems don't work, and actually technological innovation is one of the things that happens, and it will be disruptive for a cohort of people. But getting ahead of that would be a good thing, particularly if you're young, because you've got largely a bunch of older farts like myself that might not necessarily understand what they're talking about and certainly not able to keep up to the same pace. So I certainly think that's definitely something they should do as well.
Have you ever considered writing a book yourself?
Oh, who would want to buy a book that I wrote?
Well, I certainly would, given that you've got practical...
Life in the fast lane, tall tales from the city, some of which might have been mine and some of which I might have appropriated from broker meetings.
Oh, man, that would be amazing. Come on. That's got to be recorded, because that stuff doesn't happen anymore, right? So I'm guessing it doesn't. I mean, in our day in the city, all sorts happened.
So I'm on the fringe of it now. Now I lurk in Mayfair, and obviously I don't work for a big bank, but it was certainly being de-risked, and shall we say, there was a lot of changes. But I think just like there was an analogy from a Bank of England governor a long time ago about the problem with regulations and it squeezes the balloon. So the problem that you have with the balloon squeezing is the risk doesn't disappear. It just goes off and finds somewhere else where, it's going to stretch the market. And I think that's a fairly good analogy about what's going on in some of the private markets at the moment. Humans don't change. And I think that what's probably happened is some of the traditional firms that, shall we say, had some of the behavior, with the hindsight of history, might not be applauded, has moved into other darker areas of the city. So, I'm aware of a few high-profile firms that wouldn't be normally your normal banks that have issues, usually around Christmas parties.
Yeah, that's a brilliant way of putting it. Wouldn't be applauded. I love that. That's very funny. We've probably taken a few of your potential media picks already, but I'm just wondering, Tim, have you got any further questions? Or
no, I think we've already had the media picks round as well. Pretty
much, yeah. Ben, was there anything that we hadn't asked you about that you wanted to say? You were talking about liquidity, and I think maybe that's a subject that perhaps we could return to maybe on another pod, or if you wanted to say something about it now.
No, I've kind of covered the key thing. The main thing I'll just say is just it's really dull, but I tend to look at the world probabilistically. And just going back to your earlier point about sort of the fourth turning, and look, there are parts of the fourth turning that are definitely worth reading, and it is very informative. But then, the scientist in me tells you that actually, there might have been 999 other books that made similar predictions, but this is the only one that works. So, for a sheer faction of a factor of probability that somebody's going to come up with it. But there are certainly some really good points in there. And going back to the sort of attractor concept about, look, just because that is there is definitely some stuff going on. There is definitely some cycles going on. But the point I'd just make to your listeners that volatility clusters and risk clusters and the kind of, again, going back to the pinball analogy, that there are periods on the pinball machine where you are going to run into more obstacles. And that's potentially where you need to think about things. So to Tim's earlier point about may you live in interesting times, we are moving into a world that, when you look at that kind of chaos probability world where there is a lot more volatility clusters, your investors need to think about a couple of things at that point. First one is getting out of the market's easy. What psychology tells you, getting back in is actually very, very hard. And most people lose money because they don't get back into the market, which is why it's often the case, better off just to leave your cash in there. There's a fantastic piece by Duncan Lamont from Schroders, which he's made available on the website, just talking about how much money has been missed, how much opportunity cost there has it because people have sat on too much cash. So just because there's a volatility series of clusters coming up, just be aware you are going to have to get back in. That is what's going to make money. You have to, the classic Rothschild quote, blood on the streets. We are coming up for a series of those volatility clusters, and there are some, attractors, one of which is the government debt levels are not sustainable. So, to your point, that at some point, that bond market is going to run into that problem. This is a binding constraint at some point. We just don't know where it is. So I would just phrase it like that, just look at the world. It moves in long paths for long periods of time. They are the path of least resistance, but you do come into clusters. They are relatively predictable. It doesn't necessarily mean there will be a bad outcome or positive outcome, but it just means you are not getting paid for that uncertainty in your portfolio at that point. Hopefully that makes sense.
Yeah, absolutely. Great stuff. So, Tim, were you saying that you didn't want to do media picks because we've got?
No, I think we've already had it.
Yeah. Okay. Fantastic. Well, Ben. So I'm sure there's going to be people who want to read your Substack. I certainly do, and I want to know where we can find you. So tell us your handles.
Yeah, I'm on LinkedIn. So I post stuff on there, but for the more in-depth stuff and things like that, it's Bax, BAAX 1001. And the sort of Substack has got the name of T-bills, thrills and bellyaches, which if you're a certain generation will aware of the cultural reference and where it comes from. And, I publish a client note, which is usually quite clean and refined every quarter for anybody that's interested.
Brilliant. And how do they get that? Do they have to be, obviously you have to be a client, right? So
No. It's free on the website at the moment. So that might change, but no, at the moment it's freely available.
So give us, sorry, I don't know if you've just said the website or if I just missed it.
Oh yeah, Henderson Row with an E on the end.
Henderson Row.
ROWE.com.
ROWE.
Some stuff gets replicated on the US website, but the UK specific stuff is on there.
Absolutely brilliant. As always.
Thank you very much for having me on the show.
Thank you for coming on. It's been such a pleasure. Really interesting and great fun. And
and if you want to come over and lurk in Mayfair, I'll happily buy you guys a beer.
That would be fantastic. And we'd definitely love to have you back on. So all the very best.
Cool. Thanks, guys.
Cheers, Ben.
Have a good evening. Cheers. Bye.
Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.